welcome to today's webinar on enterprise commodity risk management in 2023. Today we will talk about the opportunities and challenges for finance departments. I am Federico Melotti, and I'm joined here today by Giuseppe Mitrano, who is Wilmore CEO, and by Terence McIver, who is Market and Risk Analyst at Wilmore. So, again, today we will talk about the commodity market outlook for the next few months, and we will see the opportunities and challenges that lie ahead for finance departments. We will explore how it's possible to establish a comprehensive risk management program and why that is important to mitigate risks and to identify opportunities in the commodity markets. So we will also try to highlight how finance department can transform themselves from a cost center to a revenue generator by adopting a proactive approach. And by the end of this webinar, I think you will have gained valuable insights that could help your organization navigate the evolving commodity markets. I see that also several accountants and advisors connected, and I'm happy to see that. I remind to all of you that Wilmore has a specific partner program in place, so I'm happy to discuss it further. So again, I hope that this session will be informative, and we encourage you to ask questions. Now, just a few lines about Wilmore. So who are we, for those who don't know us? Wilmore is a FCA regulated investment management firm, and we're a proud signatory of the United Principles of the United Nations. Our ultimate goal is to help clients in managing risks, market risks, and so increase the predictability of their business. This is our team, again, for those who have never worked with us so far. And again, our expertise is in the field of interest rates, credit, and derivatives. So with that, I thank you again for joining us today. And I will turn over to Terence McIver for the commodity market risk outlook for the next months.
Thanks, Federico, and thank you for everyone joining on this webinar. My name is Terence, and I'm a market and risk analyst at Wilmore. So the first slide that's coming up shows a wide range of commodity price performance since the start of 2022. We can see how at around the midway point of 2022, we saw the peak of commodity prices, after which they, in most part, collectively have come back down to prices similar to that of what we would have seen in 2022. So this pattern really follows in line with the trend of interest rate hikes and inflation that grew so rapidly in 2022, which has subsequently sparked concerns of the possibility of recessions occurring this year and the subsequent expectation of a slowdown in economic activity and therefore commodity demand. As we dig deeper into prices, it's quite noteworthy to see that commodities thus far have been less volatile in 2023 relative to 2022, which was rather an extraordinary year, particularly for natural gas on the back of the Russian-Ukraine war. As we see, natural gas so far this year has been around half as volatile compared to last year. And the graph below shows a current prices within the red circle relative to 2022 median and the previous 5 years before that median. And the really key takeaway from that graph is that we can see that even though prices have somewhat come down this year, they do remain rather elevated, particularly for metals, which we can see have actually grew this year owing to strong demand prospects driven by the reopening of China since it abolished its zero COVID policy. To a more macroeconomic view, here is a chart showing IMF real GDP forecasts. The standout data here really is China. It's shown in the red line, and the world forecasts. We can see that China is forecasted to achieve strong economic growth this year, again on the back of its abolishing its zero COVID policy, but then is subsequently forecasted to somewhat decrease in growth from there on. Meanwhile, as we look at world GDP, in the blue line, we can see that it's actually expected to grow at a slower pace compared to its 20-year average, which suggests for us that commodity demand worldwide may remain dampened relative to what we experienced in the last decade or so. The next slide here shows World Bank price forecasts on the top, indexed from 2010. Their forecasts really further reiterate the point that while we have most likely seen the highs or prices in 2021, 2022, they will not go down drastically and will remain rather elevated for the foreseeable future. The graph on the below shows China PMI, manufacturing PMI, and it shows that it's actually been a huge uplift in manufacturing activity within 2023 so far, which really supports the view of strong GDP prospects for this year and the possibility of a short-term increase in demand for commodities from that region, particularly for construction-based materials such as iron ore. A factor which may push commodity prices higher, particularly for those which are predominantly priced in dollars, is the weakening of the US dollar. The chart on the left shows the DXY, which is a trade-weighted index measuring the strength of the dollar relative to United States' main trading partners. That is inverted alongside a Refinitiv commodity index, which just tracks the prices of a wide range of commodities. And we can see that there is normally a strong inverted relationship between the strength of the dollar and commodity prices. And having seen the dollar declined around 8% in the last 6 months due to the Fed, expectations that the Fed are near the peak of its interest rate cycle, combined with growing consensus of an incoming recession, we can see that there has been so far in 2023 a stronger correlation where the decline in the dollar has seen the Refinitiv index, commodity index, actually increase as well. So this is one which should monitor further and see if it could possibly fuel upside demand in commodities. So in summary, there are a variety of headwinds and tailwinds for commodities. For tailwinds, the main factors that we are likely to be near the peak of interest rates, and we have most likely seen the peak of inflation. As I spoke about before, China reopen can definitely boost demand, and the green transition can boost demand for a range of metals involved in the production of greener products such as lithium, nickel, and copper, and also dollar depreciation. And for headwinds, GDP, as we've shown before, is expected to be weaker moving forward. There's a growing probability of recession, which is likely to reduce commodity demand. And of course, there still remains uncertainty regarding Russia-Ukraine war and possibility of further supply constraints from OPEC. So really, the key takeaway from these slides is that while there has been some uncertainty about where commodity prices will be in the near future, there's cases for which commodities can go higher and also lower, which really highlights the importance of developing a risk management strategy to ensure that as a business, you do not potentially experience negative consequences as a result of volatility in commodity prices. So I will now pass it back to Giuseppe, who will talk about more about developing a risk management strategy.
Thank you, Terence, and welcome everyone again. And thanks so much for joining us today with our webinar. So my name is Giuseppe Mitrano. I'm the CEO of the company of Wilmer, a company created 3 years ago to allow our clients to wield more power when it comes to manage risk, and that's why we're here today. So let's dive now into the problem that we have at hand. When managing a company, we essentially have different kind of risks. So in the world of business, risk management is definitely an essential element, so regardless of the company's size. So what are these risks? The risks are interest rate, foreign currencies, commodity risks, and sustainability risks. So today in particular, I want to talk about commodity risk. And in general, I would say that the obstacles to make sure that we can have a control on our risk management are several. And so the reality is that every business regardless of the dimension, is facing unique challenges and is vulnerable to market volatility, which can definitely and greatly impact profitability. So as financial markets become increasingly complex, especially, during this last few years, obviously many companies struggle to respond effectively, so leaving them exposed to unmitigated risks or burdened with excessive charges. So the issue is also compounded by the fact that specialist data and technology that could definitely improve the financial planning accuracy are not easily accessible for business. And that's the problem, one of the problems we're trying to solve. So consequently, companies are forced to operate with increased costs. Moreover, hedging products offered by banks and intermediaries often lack flexibility and transparency, with costs increasing sometimes in a very rapid, massive way. So in fact, smaller clients, and this is the research from the IMF, in fact, smaller clients can pay up to 25 times more for their services than bigger institutions. So when I'm talking about bigger institutions, I refer to obviously banks or big financial institutions like funds. So this leads to businesses paying exorbitant fees for hedging their exposures that don't necessarily meet their unique needs, or even worse, that they do not provide sufficient value. So that's really the risk. And lastly, while companies can benefit greatly from specialist risk management, paying a risk management team can be very expensive, or sometimes can be even difficult to achieve. So what's the solution? So the solution, in our view, is our applied risk management. So essentially, this is made of two things: advanced analytics and clear strategy. So that's what we're trying to, implement here. And this is where Wilmore technology comes in. So our solution consists of two main aspects. One is the Wilmore technology, and another one is the Wilmore operation. So under Wilmore technology, we offer an outsourced team of experts, as I was saying before, that integrates seamlessly with your company. So you get a dashboard, which is our WM dashboard, that allows you to constantly monitor and manage your risk exposure, and to have a clear, accurate picture of what data are telling you on the market, and so be informed on decision making. So our custom dynamic API connections, and most importantly, I would say cloud-based architecture, provide enhanced flexibility and effectiveness. So, with the cloud-based capability, you will be able to access our systems from wherever you are. And while our innovative and on-demand calculation systems can be tailored to your specific needs, that's why our system is definitely customized. So on the other side, Wilmore operation offers dedicated risk management team for your company, of course, and ensures that data and cost transparency are always, the top of your list in terms of control and budget. We also provide execution and hedging procedures, and this is extremely important, I believe, because it gives you a plan and a strategy on how to manage your risk. And this is also the reason why reducing the business risk, especially for the coverage plan for your CO2 emissions or the optimal risk management solution, can make the difference essentially in how to manage your not only exposure but also your monitoring of performance. So essentially, our point here is three fundamental elements. So control your exposures, reduce your costs, and be able to stabilize pricing, managing to budget your expenses. In this slide, we represent what are the steps and how we achieve these objectives. Essentially, we have three steps in the way we apply the risk management tool of Wilmer, and the 3 steps are the risk assessment. So we essentially look at your current status. Then we use WM Plus, which is our capability of identifying the element of risks and the critical areas. And this is where the risk management team comes in at your service. And then we continuously try to enhance the current solutions and capabilities that you have in place to improve your exposure. So how we do this with the outsourced and unbiased risk management team with the dashboard, with the hedging and execution policy that we have, with flexible API connections, and with our data and insights. So all this leads to one important result, which is for essentially every pound that you spend in our capabilities, we expect to return up to £3 on the back of the savings, the costs that we cut, and the performance that we achieve in terms of essentially cutting, the charges, the costs, and the extra burden that you will face with normal financial institutions. So we get to the third point, which is the WM Advise, where essentially we maintain and improve the assistance with the broad range of advisory and technical expertise. We offer alternative solution in terms of managing the exposure and mitigating the risks. So this leads to what we estimate to be 60% of expected annual cost savings on your current management of the company. Managing commodities is what we are here for and explain today and help you with. So commodities play obviously a crucial role in the company management. Enterprise use commodity risk management to identify, analyze, and mitigate the impact of price fluctuation on their financial health and performance. And these last 3 years, from COVID to the war to the inflation, commodities clearly have a center piece in what is the management of the health and performance of the firm. So this applies to various commodities. Here you can see energy products, metal, and soft and semi-soft commodities. But essentially, the management of the commodity risk in an enterprise can reduce the exposure to negative price fluctuation and obviously improve, that's the most important thing, the long-term financial stability. So let me share a case study now with you. That's what happened recently with a company we helped with. Essentially, Wilmer recently worked with this energy-intensive enterprise seeking to gain a comprehensive view of its exposure to raw materials and reduce high costs charged by their banking providers. And our customized solution integrated seamlessly with the company's system. One thing that I really like to remind all the time is that we try to impact as little as possible the current capability of the company. So in this case, we have an Excel add-in that is feeding into your system and providing access to up-to-the-minute data for tracking mark-to-market exposure and creating scenario analysis. So through our risk management analysis, we identified that the company was paying more than 10% in fees, and that really need to specify that this 10% in fees were a combination of several components. One is and the most relevant one's credit charge, so the charge that is necessary for a company to protect itself from the other counterparty risk of failing. And in general, some of the fees also that we know that were not transparently stated. That's one of the relevant element. So essentially, with our approach, we enabled the company to save more than 2.5% on its overall exposure of 30 million pounds of commodities, providing significant cost savings and, most importantly, putting the company in a position to improve their financial stability. That's what we really aiming for all the time. So with our expertise and tools, the company was able to manage its risk exposure. So the centerpiece for these activities, Wilmore dashboard. So Wilmore dashboard is essentially our technology behind our team, and our dashboard is essentially digital data delivery and analytics solution that enables the users to stay up to date and in control of the market. And this is happening both with live and historical curves, both spot and forward. And all this is automated, is an automated process. So what sets our dashboard apart is essentially the Excel add-in, as I said before, and we have several components like the up-to-the-minute market data, the mark-to-market pricing, the monitoring of all components of financial markets. And the most important thing is the cloud-based capability. All this is an open integration. We use open source data, and this is extremely important to make sure that everybody can interact with our system. Now I pass again the presentation to Terence to illustrate more into detail how the Wilmore dashboard is working and what are the capabilities and potential solutions that we can provide. Thank you.
Thanks, Giuseppe. Before I show the dashboard, I'd like to give some context on which the data on the dashboard is based on. So in this example, we'll be showing a case study of a company who is exposed to natural gas. So we'll be working with a company who are energy enterprise seeking to gain a comprehensive view to their exposure to Dutch TTF natural gas. So the company had three sources of exposure to the commodity. So that was through fixed contracts, swaps, and market exposure, i.e. they have no hedge. This company has two manufacturing plants which use natural gas, and they're expected to consume a total of 52,500 megawatts in 2023, with subsequent year consumption projected to grow by 10% per annum. How we help the company is that we developed a customized solution, seamlessly integrating their data into an Excel dashboard and add-in, providing access to up-to-minute data to track forward prices, mark to market their exposure, and also enable them to perform scenario analysis to determine possible outcomes which could occur from changes in their consumption amounts or changes in price. So as a result, with our support, we were able to enable them to gain a comprehensive view of their financial risks, provide access to both live and historical data. They were also able to, through the dashboard, enter, view, and analyze trades. They would also be able to price swaps, either at live or historical prices, and enable them to compare that to prices that they would have paid or may have been quoted, and also map out their exposure, cash flows, and present value of cash flows. So now I will share the dashboard. So this is the control panel of the dashboard. Here the user can initially update all the calculations, and we can see here that at the minute it's up to date. The last time the data was updated was less than a minute ago, and there's also a quick link where they can quickly go to one of their desired tabs. The first tab is the swap pricer. This enables the user to enter details of a swap to be able to price a swap, and here they can choose whether they want to do it based on prices as of now or as of a specific date. A quick feature is the user can enter in a date to obtain a quick forward. So for example, if I change this to April 25, you can see how that changes the price and also moves along the forward curve. So the black line here is the historics, the cross here is the spots, and the dotted line and the labels are the forward curve. So here on the right, you can see the futures for the commodity, monthly futures, quarterly futures, seasonal and yearly futures. And just to reiterate, the tabs in the cells in green are the ones which the user can change as they like. So in this case, we've just gone for a trade date as of today. We've been receiving the floating leg. Here the user can choose from a wide range of discount curves that they would like to choose depending on where they reside in their preferability, and also the start date and the end date of the swaps, along with their a price which they would have been quoted, or one you just like to find to see what the impact would be yourself. So in this example, I've just chosen 1,000 megawatts an hour for each month for the period analyzed. And we can see the resulting cash flows, both from the floating legs and the fixed legs. Here is the market price, discount factor, and the resulting aggregate amounts relative from the floating to the fixed. So we can see here that based on the price of 48 megawatts, 48 euros per megawatt, that from a total PV present value side, they will be minus 248,000. This cell here enables the user to see what the mid-market equivalent swap rate would be at that period of time for that swap, and the user can also enter in related hedging costs which they may be aware of to see what the swap price would be once you take those into consideration also. So then when taking into account both the entered swap rate, you can see what the difference in prices would be relative to a variety of different cases. So as I spoke about before, this enables the user to input their projected or actual consumption, depending on what dates they have selected. So here we can see it as 52,500 megawatts for 2023. This is split between two different plants. And just as an example, in Q1, in provider one, they slightly decrease in consumption. And as you can see, it grows slightly in each year. So I'll now move on to the swaps portfolio tab. This tab enables the user to input swap trades that they have completed so they can manage and track the progress and mark to market their exposure. So again, as the previous sheet had, you can select the start dates, end dates, and also the valuation dates. And then the user has the ability to input 15 swap hedges at this current moment of time, but of course we have the ability to add more if required. So the user can input the counterparty reference details, the date on which they completed into the swap, and the start dates and end dates of the swap, along with the swap price and also any related costs that they're aware of. The user then has the ability to input the schedule, so the quantity of the swaps for each month. And in this case, you can see there was around 500 megawatts for a period of time, followed by nothing, and then 1,000 megawatts thereafter. So in this example, we have 3 swaps. And once this data is entered into, the resulting cash flows are automatically calculated. And also the present value and the unrealized present value and the realized P&L are calculated automatically. And you might have seen there that some of the numbers may have changed. This is based on the live data because the valuation date is as of today. So we can see here the realized P&L as of the valuation date and the unrealized. So in this example, some months have already gone past, and this is based on historical data. So the user can see what their resulting performance on the swaps would have been so far and what is projected to be in the future. Then this is broken down by notionals amounts and also an aggregate swap price. This is both done for the valuation date and also as of the date which the swap was entered into. So this is done for the remaining swaps automatically as well. And then an aggregate swap portfolio summary is provided here, showing the total quantity amount, the weighted average swap price, along with the total hedging costs, and as of again, the trade date analysis, and also as of the valuation date analysis. So we can see here, for example, as of the trade date, the average mid-market swap rate would have been around 51.74, where as of the portfolio is around 60, which is a difference of around €8. Now, there is another tab where you can input your fixed contracts. And in this example, it's based on a scenario whereby the company can fix a certain percentage of their consumption, of their total consumption, as a fixed contract and at a fixed price. So in this example, starting from the start of January 2024 to the end of 2025, the company is able to fix 15% of their consumption at 49 euros a megawatt. And unlike the swap portfolio tab, the user, this is automatically calculated and fed in, so the user doesn't have to make any adjustments on the resulting monthly cash flows. It's all done for you based on the dates that you've inputted. And again, here we put 4 different fixed contracts, and the resulting aggregate values are displayed here. So going back to the swaps, all the swaps that were inputted in this swaps portfolio tab are then being able to view individually in a similar format as the swap pricer, where the user can select from their range of hedges that they've inputted. So for example, if I choose hedge 1, the user can see first here is the historical performance as of up to today, just to see, so from whenever the company entered into the swap, how the price actually performed, and also to see the forward curve as of the date. And you can see here there's 2 different lines, and you might be questioning why there is a gap in the middle. So this shows the resultant monthly swaps in which there is a swap value. So for example, as we see on swap 1, there is a period where there is no exposure at all, and this shows the strike which was agreed in the swap and the mid-market swap equivalent rate. So you can see that there is a difference, and the strike being paid is higher than the mid-market equivalent swap rate. And again, the user can see the monthly cash flows, and it's quite interesting to see in this case, at the beginning, they actually had positive cash flows, but then in the end, it was negative. So all these different tabs all combine into one within the total gas exposure tab, which enables the user to see their aggregate exposure split by the different sources of exposure and also perform scenario analysis. So again, the user can either select to do analysis as of a certain date. So in this case, you can go historical. And for example, if you wanted to do 24th of Jan, you can put any date you would like in here. I'm just going to keep it on live for this example. Again, the user can choose the discount curve they would like, and also the start date and the end date. So on this main graph here shows the curves of all the different sources of exposure. So the first one in the light blue is their swap curve. So this is the aggregate weighted average amount of what they're paying within swaps. And for the whole period analyzed, we can see that looks to be one of the most expensive sources of exposure. We then have the light blue, which is the fixed contracts, and you can see that fixed contract hedge hasn't gone for all the way in the period analyzed up to 2027. We see also the dotted line, which is the forward curve of TTF natural gas, and then the navy line is the aggregate exposure of the company. So this combines all of those 3 different sources of exposure to give one aggregate exposure. So further breakdowns are provided here, both as of megawatts and the price, and also as of the monthly notional amounts. So we can see here that the swap hedges is at the bottom, and the light blue is the fixed contracts, and then the resulting unhedged amount. Again, like in the other tabs, you can see the monthly cash flows broken down by the different sources of exposure, and you can also compare them to market prices. So in this tab, the user can also conduct scenario analysis, and they have the option of to first do shifts, where the whole curve and the whole period analyzed can either be adjusted for notional amounts or for changes in price. So for example, if the user wanted to see if they would in fact consume 20% more than they have forecasted, what would the impact be on the aggregate exposure? And you can see how the curve shifts accordingly. We put that back. And you also have the ability to do a more granular approach where you can do it for specific years. And for the first year you in the period analyzed, you can also do it by quarter. So for example, in 2026, if we think that we're going to do another 20% of additional consumption, you can see how the curve shifts accordingly. Now, the same can be done for shifts in price. So how would my exposure change in terms of price? So for example, if euro megawatts increase by 20 euros, you can see how the price changes. So that is our dashboard in a nutshell. I'll now pass it back to Federico, who will answer any questions you guys may have.
Thank you, Terence. We are back to the Q&A. I would like to see if there are more questions. I see that 2 questions are already here. So maybe Giuseppe, this is the first one I can pass to you. So if you can give us an example of cost savings reached, since you have talked about cost savings before. So if you can give us an example of cost savings reached both in the commodity and I guess in the currency space exposure.
Thank you, Federico. What I was mentioning before about our case study is my actual starting point. I would say that essentially we notice 3 different kind of charges or fees when clients are working with financial counterparties. Essentially, the first one is the one that we all know, which is the management fee. The other one is, or hedging fee, as it is called for risk management purposes. Then there is what is declared to be a credit charge. And then there is another fee, which is not there on the paper. It's a hidden fee, essentially. And this is probably the easiest to address or to fix, because if you have appropriate tools to manage your data and to manage your exposures, you can immediately find out what is the difference between the market and what you have been shown, or the market and what you presumably should see as your exposure. So the system and the tools, the data that we provide or help you source are essentially the tools that you need to solve for a cheaper solution. And then there is a second part, which is the credit charge. Essentially, the credit charge is a function of the rating, the capability, the default risk, and a series of components that are put together, making the amount of the credit charge that normally a bank or financial institutions is charging, and for a reason, when it's dealing with another counterparty. Usually a company small like ours will have clearly less important rating, not as good as a big bank or a big financial institutions, and this is clearly the reason why the credit charges will be higher in this condition. So we help companies to calculate exactly if that credit charge is correct, and we help to also find alternative solutions and essentially manage these risks. So for FX, as you mentioned, Federico, this is surprisingly high as a cost. We found out that also in mature markets like the European markets, where we normally talk to clients, these costs can vary from few tens of basis points to few percentage points. So we get to 2.5 or 2% for FX market, especially when we talk about forward curves or calculation for longer terms. So these are typically the case where we help companies to find out what is the real costs, and this is what we are trying to assist clients with.
So yeah, I think the whole point comes down to get the right data, the right amount of information that an enterprise needs to plan and anticipate what could come next.
Yeah.
And that's what we try to do, right? To empower our clients.
Not only, but if we want to quantify what is the amount of cost savings that this kind of risk management policies, hedges, practice can generate, an expectation, which is not an exact number. That's important to remark, but an expectations of what we could save in terms of costs, in terms of benefits generated by this kind of practices and strategies. This could be up to 60%, as we identified in our presentation.
There is another question. So does Wilmore partner with accountants, I guess, and advisors? Yes, as we said earlier, we recognize that advisors and accountants have a big, let's say, deep understanding of clients' needs and also clients' goals. So I think that they can play a critical role into understanding how we want to achieve those goals. And we have a specific collaboration agreement in place for that. And so again, I am happy to discuss it with any of you, because again, the ultimate goal, I think, is to add value for the clients. And about that, I think that adding this kind of service to adding a service like this to their practice is a nice opportunity also for accountants and advisors. I see there are many of you connected today. I would like also to highlight something else, that we always perform a free assessment, free risk assessment at the very beginning of every relation with any enterprise, where we try to measure and see if there's any area where we can add value. And that's, for example, what Terence was talking about before. So understanding how that specific risk is hedged and if there are excessive charges, for example. So I don't see other questions. If you have other questions, you can also ask us later privately. So I guess that we are coming to the end of the webinar. So I would like to thank everybody for joining us today, and I guess that we will see you in our next episode. So thank you again, and have a great day.